Good evening, everyone. Thank you for taking the time to join us in this month's webinar. My name is Chester from the corporate sales team who specializes in the US markets. Together with me, we have Ying and Xiong, who will also be speaking in the later parts of the webinar as well. So the flow of today's content would be a simple discussion of the market outlook for 2022, followed by the various industries with opportunities. We will then have some technical analysis and finally closing off with some Q&A. At any point in time, do feel free to post your questions in chat. We will do our best to address them at the end of this webinar. So without further ado, let's start off the webinar with market outlook of 2022. Okay, before we talk about the outlook of 2022 and things to look out for in the upcoming year, I would like to first bring us back to the March of 2020, where I'm sure we all know about the dip in the overall market, which was most likely brought on by the introduction of the coronavirus, or as we call it, COVID-19. What I would like to point out in this particular chart would be the fact that after the market has found equilibrium at the bottom of the dip, it maintains a constant bull run to reaching all-time highs and to now current levels. It boasted an approximate gain of 116%. And just a little fun fact for you guys, right? It actually outperformed the rally it had from 2002 to 2007, a span of 5 years. But in this current run, it took less than 2 years. Next up, let's dive into the performance of just 2021 alone. This year saw an increase in performance by about 30%. Well, with 2021, COVID-19 have already been around for almost 2 years. By then, many market forces have already influenced the market. So let's talk about some of the various factors that could have contributed to the gains of 2021. So firstly, availability of vaccinations. With vaccines in the economy, it quickens the pace of reopening and thus recovery of the economy. As vaccination rates increases, we will be able to gradually move from a situation of a pandemic to a situation of an endemic, thus approaching the new normal and living together with COVID-19. Secondly, the increase in money supply in the economy by the officials through monetary policy of buying bonds. The increase in money supply will promote growth to the economy that was affected by the pandemic. Thirdly, relatively low interest rates. The Federal Reserve has committed to actually keeping interest rates low to boost the economy as well. Lower interest rates will allow for lower costs of borrowing, thus easier for companies to actually expand and grow. And fourth, lower unemployment rates. So this is brought on by the increase in the money supply and the reduction in interest rates. Companies are, as like mentioned previously, able to expand. This will cause an increase in demand for workers. So with more people being employed, consumer spending increases as they now have more money to spend. This in turn fuels the economy. So last but not least, new investors. So we have seen many new investors during the pandemic. In my opinion, it could have been due to the free time that most people are getting during the lockdown. With not much to do at home, many of them do take the time to learn about the stock market. This brings on added trading volume to the market and also with it more optimism for the market sentiment. Right, so I'm pretty sure the list could go on forever, but I think everyone here would be more interested in 2022 itself. So this brings us to the million-dollar question. Will we be expecting the trend to continue into 2022? Right, so trying to tell the future of the stock market is always a tricky thing to do. The same goes for 2022. So with still many uncertainties about the pandemic and actions from the Fed, what we can actually do would be to consider some key factors that could play a part in the performance of the stock market. So namely, number one, COVID-19, second, inflation, and lastly, the interest rate hike. So when it comes to COVID-19, we will never know how it plays out. One thing's for sure though, it's the fact that COVID-19 is not leaving our society anytime soon. It would really depend on how quickly we are able to obtain herd immunity and thus welcoming the new normal in our lives, that is living with the virus amongst us. So in the meantime, we could take a look at how COVID-19 has affected the economy. Firstly, it has brought the economy to a slow pace. With the onset of the virus spreading like wildfire, the first go-to response would be for the mass public to stay indoors. So this has caused migration from the physical interaction to the digital interaction. We are able to observe that social or work-related events are turning towards the digital space. As a result, the traditional brick and mortar businesses took a bad hit as demand for physical shops saw a drastic drop. This definitely contributed to the rising unemployment levels back then. Secondly, the pandemic has also caused disruptions to the supply chain. The root of the problem has to be attributed to countries imposing lockdowns across the cities or within countries. So with this, suppliers are now not being able to fulfill their orders. The sudden halt in the supply chain then resulted in many firms not being able to honor commitments to their customers as they now are running on an inventory deficit to sustain their operations. As a result, supply being lower than demand, and we will see an inflation as well. The COVID-19 pandemic has also accelerated the mass public towards digital space adoption. Well, I personally feel that this could be a plus point. The mass adoption of the digital world will happen sooner or later anyway, or maybe even within the next few years. So this pandemic has forced us to rely on the internet to carry out our daily tasks. It is good as we are now embracing the ever-evolving technologies of the world, and it certainly improves efficiency on certain tasks. But however, like a double-edged sword, moving towards the digital space has also showed us the possibilities of cybersecurity attacks and online scams. Yes, so do take note at the infographic from the FBI. It shows the increase in such attacks as scams around the world slowly increases as we move towards the digital space. Okay, for us investors, right, it will be good to also take note of vaccination rates. That's because with higher vaccination rates comes greater confidence in lifting restrictions. So with that, we will be able to see a healthy economic recovery. So over here, we have the vaccination rates of US and the entire world. As we can see, US coming in at approximately 63% vaccination rate, while the entire world coming in at 50%. Okay, the introduction of the pandemic has also shown us a boost in the healthcare sector, without a doubt. The chart here shows an ETF of the healthcare sector. This fund seeks to track the investment results of an index composed of US equities in the healthcare sector. So taking data right from the dip that we mentioned, the March 2020, all the way until the end of 2021, this particular ETF has actually shown gains of approximately 90%. All right, moving on to the next factor that could play a part in the performance of the stock market. That would be inflation. So the cause of inflation in topic for today would be caused by the increase in money supply by the officials through monetary policy. The main reason for such a move could be contributed by the negative effects brought on by the pandemic in response to the failing economy. So this increase in money supply by the officials was to address the fallout and to facilitate for an economic recovery. However, the government responded excessively with an unprecedented stimulus. So as a result, we are now experiencing higher than normal inflation rates. So let's take a look with the inflation rates across the years, right? So from a time of pandemic to a time of non-pandemic, to a time of pandemic. So with 2019, we have 1.81%, year 2020, 1.2%, and year 2021, 4.7% inflation rate. So keeping in mind that the target was actually to always maintain it around 2%. So with this stimulus, money supply that is circulating has drastically increased, thus leading to such inflation rates. There is now a mismatch between government revenue and spending, and it has gone to a reckless situation as a national debt, now coming to an approximately $30 trillion. So this brings me to my next point, budget deficit. As the government is now operating on a budget deficit, they might want to consider to increase the sale of bonds after tapering to improve their cash flow. This will then cause bond prices to decrease as the supply is now higher. So as a result, interest rates will increase. And this is because interest rates shares an inverse relationship with bond prices. But yeah, generally an increase in interest rates always have negative results for the stock market, which we will talk more about in the next few slides. So in times of inflation, it would be good to note that some stocks do perform relatively better. These will be value stocks that belong in the banking, the insurance, consumer goods, and energy sectors. As we can see from the chart over here, comparison is being made between value and growth stocks. Value stocks being the light blue line and growth stocks the darker blue line. So we can clearly see that they have shown higher performance in our current state of higher inflation. So not to worry, the various sectors will be discussed shortly in the next part of the webinar. So do stay tuned for that. Okay, now coming up to our last factor that could play a part in the performance of the stock market, it would definitely have to be the interest rates hike. Okay, so the interest rate hikes, the interest rates has always been a tool used by the Fed to kind of control money supply and ultimately inflation rates. So for today's case, it could be the simple act of increasing money supply by buying bonds to affect the interest rates eventually. With this flow diagram over here, it shows the relationship between bond demand, bond prices, and interest rates. Increased demand in bond caused by bond buying will increase bond prices. Higher bond prices will then cause a reduction in interest rates. The opposite will happen to interest rates when bonds are being sold. Okay, so we know for a fact that the Fed has been aggressively buying bonds to increase money supply in the economy to fight off the negative effects of COVID-19. This was in the earlier periods of the pandemic. However, in the last quarter of 2021, there has been talks by the Fed to reduce their bond buying activity. At the same time, the Fed is also said to shrink their balance sheet to reduce their holdings, all of which will increase to interest rates that could curb the high rates of inflation. Now, well, we do not know when the change can be observed in interest rates, but it would be good to actually take note about the pace at which the interest rates are being changed. So increasing the interest rates too quickly will harm the economy, as it will result in companies not being able to adapt to sudden increase in cost. Ultimately, the economy suffers. And with regards to the national debt that was talked about previously, okay, so this increased interest rates will add on pressure to the government as debt cost increases together with the interest rates. It will now cost more to service that enormous debt. So now, what does this mean for the stock market? So rate hikes generally have negative consequences on the stock market. It causes stock prices to fall, and it prevents companies from growing due to added cost. In the chart below, we are able to see the comparison made between the overall stock market and interest rates. An obvious inverse relationship can be observed within this comparison. The red line being the stock market, while the interest rate shown by the other two lines remains low. So how does an interest rate hike affect the stock market? A rise in the interest rates could be translated to the fact that the cost of borrowing for companies will increase. The simpler flow diagram should give us a better understanding on how the stock market will be affected. So in short, higher cost of borrowing for companies prevent them from growing and expanding. This results in lower margins and eventually a fall in their share prices. So as more share prices fall across the board, the major indexes such as the S&P 500 and the Dow will drop as well. This will then be translated to weaker gains from the market. Investors might eventually deem the stock market to be less attractive and will consider to invest in other asset classes. So this brings even more volume out of the the equation. So with that all being said, certain industries do benefit from an environment of higher interest rates. They would be companies in the financial industries. Such examples would be your banks and your insurance companies. So simply put, why do they benefit? Well, with the increase in interest rates, these companies are able to lend out money at a higher rate, thus increasing their revenue. So after exploring the key factors that might be affecting the stock market in the near future, and also after reviewing the bullish move that we had since March of 2020, forecasting the future of the stock market for the coming year will definitely be a relatively difficult task. We are still being faced with many uncertainties, mainly caused by the continued impact of the COVID-19 pandemic. At the same time, not forgetting the added uncertainty caused by the new Omicron variant. This could still cause further strain to our supply chain, and this in turn impact global demand, and as a result, making inflation worse. So, but comparing to when the COVID-19 pandemic first hit, the economy seems to be on more solid footing now. We are able to see that the policymakers are beginning to feel confident, whereby there are plans to increase interest rates and to end the quantitative easing, thus shifting their focus to actually deal with the inflation. So investors can expect the Fed to be one of the dominant forces influencing the market for 2022. The pace of which the interest rates increasing would be crucial. Right? Okay, so I would also like to actually draw your attention to the following chart that compares the Russell 2K and the S&P 500. Based on historical performances, we are able to observe that both indexes move similarly in proportion amongst themselves. As of now, there's a clear disproportion between the both performances. Hence, a few companies in the appropriate sectors might still have potential in line with market sentiment. I believe the various sectors will be covered by my colleague in the later part of the webinar, so do stay tuned for that as well. So with all that said, much of 2022's potential performance depends on all things that none of us are able to predict accurately right now. With the three key factors looming over every investor's head, the best we could do would be to be ready to adapt as more information presents itself. Opportunities are constantly being found in the stock market in times of uncertainty. So that's because crisis comes opportunities. Yeah, please stay tuned for the next section of the webinar as my colleague goes through the various sectors and industries that might have potential in our current market situation of high inflation rates and the inevitable rate hikes. So to end off my portion, I would say that it would be important to keep ourselves grounded with our expectations, where we are not pampered by the magnitude of the bullish movements previously experienced. We should not take it for granted and should always be ready to adapt and to take on either an offensive or defensive posture with regards to the markets. Okay, I've come to the end of my portion, but before we move on, right, just like to share with you some promos that Phillip are actually running right now. So the first promo that we're doing would be the Chinese New Year giveaway of $100 Grab food vouchers to 22 lucky entrants. So for more information, do check out the link in chat. Secondly, the Cash Plus account promo rates has been extended to 31st December 2022. If you guys have not signed up and are interested in it, do check out the link in chat for more information. And lastly, we are also having a referral program whereby you will get 888 cash credit when you refer a friend to us at Phillip. For more information, feel free to check out the link in chat as well. Okay, so yes, thank you for your attention so far. I will now pass the time on to Xiong, who will be discussing on industries with opportunities. Okay, thank you.
Hey guys, thanks Chester. So moving on to my part, I'll be talking about the industrial outlook for 2022. But before I jump into that, let us take a look at the industrial outlook for 2021. So this is actually taken from the SP Global website. As you can see from the annual performance summary itself, the highest performing sector is actually the energy sector just last year. And of course, at the lowest is actually the communication service, while the rest performed averagely well. So as mentioned by Chester earlier, he talked about how small cap companies has the room to grow. And you can see that under the annual performance summary, highlighted in orange, the small cap 600, they actually perform so much better than the mid caps in 2021. So moving on to 2022, which everyone is excited for, what will we be looking at? So I have to bring up this Michigan Consumer Sentiment Index, the MCSI. MCSI actually tells you about the consumer confidence with regards to the market. So with that, you can see that the consumer sentiment has dropped since April 2021 to one of the lowest just this month itself at 68.8, while it has been registered at the lowest in November 2021. So with this low consumer sentiment index, what does it mean? Of course, industry to be mindful about. So with lower consumer confidence, we are expecting lower consumer spending. And of course, with that, business will actually cut back on their production. Subsequently, the economy will experience a slowdown. And so consumer industry will suffer. So of course, this will be the industry to be mindful about, such as the consumer retail, discount shops, and internet retails. So with industry to be mindful about, let us move on to industry with opportunities. So of course, I'll talk about the energy sector, which has performed really well in 2021. And of course, let us look at the forecast for 2022 itself. And you can see that in this chart, it actually shows you about the world liquid fuels, and that in 2020 Q3, there was actually an increase in demand, which exceeded the supply, therefore the hike in price for oil. And that subsequently, it is, of course, until this year, January, the oil industry is actually doing very well as well. But it is expected that in second quarter onwards, the supply will actually be slightly higher than the demand. So this will actually help to reduce the oil prices. And that US has also taken out of its reserve to actually maintain this. But of course, talking about oil, we have to take note of the risk, which is actually the current Ukraine and Russia war. So this will affect the forecast provided by the EIA. Of course, if the war actually goes on, the oil prices will actually go up. But subsequently, we have to look at how it turns out, because we have no say in what is going to happen. But moving on to the energy sector, the US electric generation by source. So why am I showing you this is that the government itself is actually encouraging renewable energy. You can see from this chart provided by the EIA, renewable energy increased, and that nuclear, coal, and natural gas is expected to drop in 2022 and 2023 itself. So why am I showing you this is basically with natural gas drop in terms of usage for the electricity generation, this will actually affect the energy sector, which is mainly the oil and gas industry. So moving on, for interested investors, we shall take a look at some ETF, which I'll use as example to go through. Why ETF? So industry with opportunities, this will be the ETF, Vanguard Energy ETF, incepted in 2004 with a market value of 7 billion and expense ratio of 0.1, last traded at a price of 87.75. This Vanguard ETF actually consists of ExxonMobil. It's located on the top right, if you can see. We have Chevron Corporation. So these are some oil and gas industry with energy mixed in as well to help diversification and of course risk management. So looking at the performance, we can see at the bottom, the year to date, the 1 month and 1 year itself. This ETF actually performed really well. So it shows that the energy industry actually performed well since last year, looking at the 1 year mark. Moving on, the second example for ETF, this by Invesco Dynamic Energy Exploration. So we can look at the top right for the top 5 holding as well, mostly oil and gas industry. So the year to date, it rose about 9.69%, but mainly we'll focus in the 1 year run, which is at 86.15%. So with that in mind, this is industry to look at. Of course, there's risk involved because of the current political risk. So moving on to that, we shall take a look at the industry with opportunities. So next, the all-time favorite, everyone's favorite, the EVs. So it is projected that the global demand for EV actually increased for 2022 itself. So with the increase in demand, what are we expecting? Definitely the increase in production. And of course, the projected increase in sales is expected. So you can see on the right-hand side, the graph, the projected sales is expected to hit above 10 million. And this is a very big amount. So China itself has already covered up to 5 million. And the second biggest is actually Europe, followed by North America. So moving on. So as you can see, these are all the headlines from the various media sources. China is expecting a growth of 5 million. And of course, Korea, Japan is providing subsidies. And that you can see that Europe itself, they provided subsidies so much so that the electric vehicle sales overtook the diesel model for the first time. So with this in mind, of course, there will be risk in terms of EVs, because currently China itself can't actually meet the demand of 5 million in China alone, and that they can only provide up to 4 million in demand due to this shortage of chips. So with that in mind, you have to take note that with opportunity, there will also be risk. So moving on, I'll go through some ETFs as examples. So let's take a look at the global X Autonomous and Electric Vehicles ETF. And top 5 holding, we have Tesla, NVDA, Qualcomm, Microsoft, and Apple. So it's quite diverse. We have the motor company, we have the tech company. So of course, the market value is at 1.427 billion, and the expense ratio at 0.68%. And of course, last traded at 28.33. So the year to date is at negative. Of course, the market has been very red, like Chinese New Year. So, but we usually for ETF, we look at the 1 year mark, which is performing averagely okay for the 1 year, because December and January, the market was very bad. So moving on, the next ETF, we have iShares self-driving EV and tech ETF. So the top 5 holding is shown above. We have Toyota, Intel, and of course, the year to date is of course at the negative as well due to the market. So for the 1 year mark, it is at 7.26%, which is not that bad as well. So moving on, we have so this is actually the summary of all the 4 ETF, and we're just gonna run through and compare a little for you to know more about ETF. So we have the expense ratio to actually maintain the ETF. Of course, with lower expense, the lower expense ratio is actually due to the higher market value, and of course the expenses that the investment companies spend to maintain the ETF itself. Subsequently, we have dividend, which is quite subjective because not all ETF have dividend. And then we have the year to date followed by the 1 year mark. So looking at the 1 year mark, all the ETF perform relatively well. Of course, EVs is expected to grow. With that in mind, there's also risk. So do take note as investors. So join our Telegram group. We have actually a Telegram group, and of course, later I'll show you a WeChat. So you can actually scan the QR, join us, and then there will actually be daily updates on what we are looking at and how the US market perform. So next, I'll actually pass on to Ying, my colleague, to talk more about the TA portion. So thank you very much for your time.
Okay, good evening, everyone. I'm Ying here. I'll be going through the technical analysis for this webinar. So the flow of this will be I'll be sharing on the 4 ETFs that Xiong has shared earlier, and also you can leave the ticker symbol that you want me to look at the chart at the Q&A portion, and I will look through after the 4 ETFs have been shared. Okay. Okay, the first one will be Vanguard Energy ETF VDE. Okay, as you can see from the chart, right, for the near 1 year, we are looking at a weekly chart. For the past 1 year, it has been moving on an uptrend, considering that it has touched a low of $32 last year during March-February period. Okay, then the price has been creating a support area at 39.67, subsequently moving higher, breaking the resistance at 63.3 in April. And after the range, right, I mean, for now, the ETFs have been moving higher towards the upside, but in order to see higher price movement, right, it's best to wait for price to actually break above this 93, 94 range before we can see more bullish momentum from this ETF itself. Okay, but I mean, considering that it's have been a bullish set momentum, bullish market structure for the past 1 to 2 years, I think for this ETF there's still more room to go. But however, just take note of the levels at 75, 63, and also 93, which they have to break to go higher. Okay, the next one we have Invesco Dynamic Energy, ticker symbol PXE. Same chart, very similar movement with the previous one. Price made a low in 2020. The past 1 year has been a bullish market structure for this ETF as well. Levels that they have to break, 23 is the nearest for now, 23.64, which was created back in 2019. So it's the same that I would say for PXE. There's more room to go as well, but however, we have to clear this resistance level at 23.64, and also of course the support level, which was turned from a resistance turned support at 19.3, has to hold that level. Okay, otherwise we might see range bounding around $13.85 to $19. Okay, next we have Global X Autonomous. This is a EV ETF, right? So it's only in COP, I think, back in 2018. So for now, it's the 4th year. It tried moving out of the range created in 2021, $26 to $29 range, which they broken back late Q4 of 2021 actually. Price tried to go higher to sustain a new range, to create a new range. However, they are met with a new resistance. Okay, the $32 area at this portion is actually the all-time high. Yeah, the resistance is formed. Subsequent movement has been moving downwards toward this previous range that actually they formed in 2021. So for this ETF, to see the more room for growth for this ETF, right, the price, we actually have to really take note of this support level at $26. It had to hold. Otherwise, I see more room of down move before attempting to go back into this $26 to $29 range before trying to go higher again. iShares Self-Driving EV Tech ETF, similar movement, is very similar to the previous one that I shared. Range bound for quite a while, but of course with the bullish market structure of this, right? They created a first range in 2021, early 2021. They break above, created another small range, and subsequently trying to get an all-time high, which touched close to $58. But with that, bearish momentum came in recent months. They formed a resistance. Price still tried to go higher, but failed to do so. Okay, we can see as for this box over here. So in order for the price to reach higher levels, 47 is the first level they have to hold. Of course, it will be best for a bullish candle closing at this level to once again show that this support is holding. Then it might try to go higher at $56 again. Okay, otherwise, for this ETF, actually, for now, I mean, you really have to watch how price action is moving. I mean, with the past few days, market has been trading downwards. It's better to trade thinly for this period. Okay, I'm done with the 4 ETFs actually. So now I will move into the Q&A for ticker symbols. So what I will do is I will do a live technical analysis on the charts that you might want to see. So with that, give me a while. I will change to the charts. Okay, I see that many have been asking for Apple. So I will do Apple first, okay? All right, the basis of this technical analysis, I'll be drawing on the daily chart. Okay, we are looking at, since for a period from 2021, March 2021 to the current date. Okay, so for Apple wise, what we are seeing is the previous 2 days they actually come close to this support level, which was created in November 2021. Price traded with a bullish closure, and yesterday it traded bullish close as well with a higher high form on a daily. However, in recent, okay, not recent month, actually it's just 1 month. As the short term wise, price has been trading lower. Okay, there's a bearish momentum, but if we are looking on a higher time frame, right? If the trading period is more than 1 to 3 months, we actually see a bullish momentum outwards. Okay, we have a trend line which the price is holding well. We might see that Apple might trade higher, but however, we need price to hold at this demand level which is created. All right, so in order for Apple to really hold, we have to see how it is going to trade and close this week. Okay, so for now the support level will be around 156.5 to maybe like a 158 level. So if today they can trade higher with a stronger bull closing, we might be able to see it trying to go back to this level, which is the support turn resistance level, which they might want to try to hit higher again. All right, so the resistance currently is at 168, support is around 157. Okay, all right, I'm going to look into the next chart. Okay, the next one will be Microsoft. Okay, same thing, I'll be looking on the daily chart. Okay, so for Microsoft, yeah, short term, same movements, is still bearish. However, for this 1 year, Microsoft have been trading higher with bullish momentum. Just have to take note that because of this recent period of price trading downwards, it's going to be very tough to really find an entry point. They tried going into this demand area with a bull closing, but however, there's still a range of price trying to hold above this support. Okay, this support level, for now, it proved to be strong enough to hold this level, but we really have to see how this week really closed. From how the indexes have been moving this week, it's still, the risk is still on, so you have to really trade thinly on this. Okay, so however, from what you see, right, I mean, from the chart itself, if Microsoft can trade above a 296 level, okay, 296 is around here. Okay, we might see Microsoft back into a range bound between 296 to 320 range. Okay. Okay, next one, I'll look into Facebook. Oh wow. Okay, Facebook range bound for close to maybe what, 5 months, 4 months. Currently, it's trading lower, breaking the support that they created. So for now, Facebook, I would say I don't have much comments, unless it can start really breaking above this 345 range. But of course, I mean, considering if you are, I mean, it's up to your investing or your trading strategy. What's your holding period, your time frame that you want to hold at? Facebook, I mean, if it's to go lower, right, it's probably heading towards this next demand level. Okay, 280. Yeah, so otherwise, this range that they formed since September, the resistance is strong. They have to trade higher for more room to go. But of course, with the all-time high at 380, we really have to see how it's going to continue from here. But as of now, it's range bound. Lower low has been formed with a bull closing, but price is still getting stuck in this range. Okay, I would say 300 to 345. Okay. Okay, Upstart. Okay, one good thing about, I mean, Upstart have been trading lower since October. Okay, clear downtrend, bearish momentum. The only positive side of it is it closed quite a strong bull the past 2 days. But however, I mean, in order to see Upstart really start really getting higher, right? We have this resistance turn support, which failed to hold and eventually went back into a resistance. It's very tough to really trade upstart now. Okay, support level far away. That's the demand. I mean, gap still around. Potential of gap fill is still there. Just have to be. I mean, if you want to go into upstart, wait for the level to hit maybe 50. Okay, wait for a bullish closure. Maybe you can look for some move to trade within the range of this level, which is maybe 50 to 85. Okay. Okay, NVDA, everyone's favorite. NVDA, okay, for NVDA, same thing, bearish momentum, past few months. In order to really trade higher, they need to break levels. But I mean, a good thing is they are trying to hold. They are trying to hold this resistance turns support. Maybe it will become a support, maybe not. It really depends on this week closing. If they can close bullish enough, yeah, this support is holding, and we might see a range play from NVIDIA. The price will be between 220 to 265. Okay, otherwise, structure-wise, yes, it's still bullish structure, but recent months has proved that it might want to trade lower for a while, right? Next level, if you want to interested to know, we will be looking at maybe 180 level already. All right. Okay. Okay, I'm gonna talk about BAC. Okay. Okay, BAC, bullish market structure. Okay, very nice. Yesterday closing was nice. Monday closing was nice, considering that it pulled all the way down to 42.5 level. Okay, which is respecting this support level that they formed earlier. Okay, then we potentially have a resistance here. Okay, I'm not going to talk about this outlier right here. More or less, it's like a breakout and failed to hold above. Okay, so BAC, Bank of America, right, will probably be trading between this range for a while until more new catalysts, or I don't know, like maybe Fed news or something like that coming in. We might see more bullish momentum. Okay, hold on. Okay, let me talk about new. For new, we are not seeing levels that it hit in 2021 anymore. Okay, it has been trading downwards for quite a while. Okay, on a higher time frame, right? I mean, if you are looking far away, right? Yes, it's still a bullish market structure for a while. Okay, for sure. They created a huge range. Okay, so I mean, price is only going to go up or down from here, right? But the question is, will they hold this level which we created back in 2020 October? Which I mean, simply answer is I don't think they would for now. Okay, considering all the market sentiments and everything in it. But of course, if you are in new, the next demand, I mean, the next clear demand that I can see is this level. Okay. Sorry. Okay. Yeah, around $20. They are coming close to it. You need to hold. Otherwise, we might see new really start tumbling quite quickly downwards. Which yeah, because from this moment, this area itself, we don't really see a strong demand or support being formed before. Okay. Resistance wise, $35, which is over here. All right. Okay, hang on now. Let me take a look at the Q&A.
So you mentioned some energy stocks and do XOM. Because John guy asked, I already answered.
Okay, let's take a look. Okay, XOM, ExxonMobil. Wow, very nice bullish structure. Okay, from November 2021. Okay, it hit a low of $31. Okay, this low was respecting the previous low in 2020, early 2020 at $31. Subsequently, it moved higher, has been trading higher and higher. Okay, so let's see where will this chart might be heading towards. Okay, they form a small support area, got respected on Monday. Okay, resistance turn support. For this resistance turn support at $65. For now, is potentially turning into a support, okay, potentially, because in order for this support to be confirmed, we would really need to see a bullish candle closing at this level, okay, $65. Otherwise, the price might trade lower into this $59 range, $58, $59 range. Okay, let's see how about resistance. I've been trading higher since, well, for 2 years now. Okay, closest resistance we would see is over here, 75, 77. Yes, 77. $77. Okay, we have a resistance here. So be careful if you are in it. But of course, once they manage to break 77, right? All this is like 4 years ago data. Yeah, we might see it ranging at 77 to 84. But of course, for now, we really have to just see whether it can even break 77. Okay. Okay. Okay, another bank, JP Morgan, range bound for the past 1 year. Okay, but however, this level need to hold. Okay, it's very clear they have been ranging for a year and now they are trying to trade lower than the support level that they created. Okay, so for JP to continue, yeah, this week is very crucial for most of the tickers, for most of the counters. I mean, they really have to show a strong bullish closure, hold the support levels, because the down move from Monday and yesterday, even though they closed bullish, right, most of the stocks have been trading lower than what they should be trading at, because of the support and the demand level that they created. Okay, so but if JP can continue to hold this level, 145, 147 level, we might see it trying to get back into a 160 range again. Okay, but for now it's range bound. Yeah, just trade thinly on this. Okay. Okay, I will do probably 1 or 2 more. Okay, let me take a look. Baba, okay. Baba. Usually Baba, I don't have much comments because very, very clear downtrend for quite a while. Okay. The nose, I mean, yes, there's signs of reversal from last month. That's why for now our price really have to hold this level. Okay. Then you see recently the range appear, they try to go higher, they form a resistance, but price failed to hold higher than the resistance. In recent days, yesterday, Monday, yeah, price is still trying to hold above this resistance. So in order to see Baba really trading higher, right, they need to hold this resistance level. Okay, resistance first support, and now it's a resistance again. So they need to hold this level to potentially see higher. But of course, if it does hold that level, right, we might be able to see maybe, yeah, we might see a 150, 160 range. Okay, support wise, yeah, very, very far away, created from what, 2017. Nice. Yeah, it's a resistance and support, but for now, Baba, yeah, still no uptrend yet. Still have to wait, but of course, signs of reversal might be coming. Okay, so we have to see this range itself holding the price. Okay. Okay, last one. I will look into AMD. Okay, AMD chart looks very similar to NVDA. Resistance, turn support, turns resistance again. Currently, price try to trade lower. We have this level. Price need to hold this support level 110. Okay, but with yesterday's bearish closing, right? Okay, I mean, a good thing is that the price is still trading above the support level. Okay, so with yesterday's bearish closing, it still had not made a lower low compared to a Monday close, Monday low. So if we can see a bullish momentum coming in at this level 110 to 120, AMD should be ranging for a while until they try breaking above 120 range again. Okay. Okay, just now I talked about NEO, then someone asked about NEO. Hang on, let me go through. Okay, for NEO, right? The question was why did NEO increase in share price exponentially, and why does NEO share price now tumble? Okay, I believe that, okay, because in 2020 to 2021, right, EV, I mean, the digital space itself has been growing very quickly. Okay, considering that COVID had come about, right? During this period, the later portion of 2020 to the early portion of 2021, right? Almost every company you buy into, almost every stock you buy into is moving on a bullish momentum. Okay, there's so much optimism in the market. However, in recent days, I mean, considering that the market sentiment has already priced in that bullish momentum back then, the price back then might not actually be a true value of the company, the indicator of the company. Okay, so because market really I mean, if you look at it on a technical analysis point of view, right, it's actually moving a lot more on market sentiments instead of other things. I mean, all the fundamentals and everything is all the catalysts that will be involved in it. But mainly, it will just really run on how the market views the company or the stock itself. Okay, I hope I answer you on that. CBX. What is it? Hang on, someone asking for something. C what? CBX. Don't have it. Okay, give me a while. Okay, okay, last one, Chevron. I'm going to just talk about Chevron now. This is the last technical analysis that I'm going to do for the stocks. Resistance turn support 120, 117. Okay. Support, recent support 120. Close bullish, and yesterday and Monday, this support should be able to hold as long as they are going to continue this bullish momentum. The high, okay, we are nearing one we are nearing one resistance, which is quite strong. Okay, let's take a look. 130. Yeah, it's around 130, 135. Okay, it's probably, it already touched yesterday actually. Okay, for Chevron to really trade higher, this energy stock, price have to create a support, okay, after breaking this 133 range, this resistance, I mean, and hold that level before we can see higher price movement. Okay, so with that, this will be the last symbol that the stock that I'm going to talk about. Okay, give me a while, I'll move back to the slides. Okay, with that, I end my session on the technical analysis. Okay, if you have more questions, you can actually send us an email or a call later. Okay, we'll do our best to help. Okay, then really appreciate if you can fill out the feedback form. Okay, you can scan the QR code now or later. There will be a link shared. Okay, adding on to my portion, right? Okay, there's actually this Poem's TA Telegram channel. Okay, feel free to join. At this channel, I think it will be easier for me to really talk more on technical analysis or the charts that you really want to talk about. Okay, the link is there, the QR code is there. Do feel free to join. Okay, we will have Q&A on every Wednesday and also weekly webinars every Monday. Okay, I will be presenting on the webinar as well. Okay, so with that, I end off my portion. Now we will move back to the Q&A for Chester and Xiong. Okay, thank you very much for your attendance. Okay, I'll give it back. Then thank you very much.
Okay, yeah, hi everyone. I'm here to answer some of the Q&As that I've managed to see from the questions that you guys are posting. So many of you actually have the same questions, so I'll just group them all together and just one shot just answer you guys. Okay, so the hot question: what is causing this market correction in January? This past few days, the whole market tumbling. So what's causing it? So it seems like actually the equity benchmarks are being readjusted from their highs as the economy heads towards the new monetary policy in fight against the pandemic and also inflation. So to add on to these bearish movements caused by the Fed, there are also other doubts from events out of the countries, such as the US-China relationships, the Russia-Ukraine conflict, and also the Middle East unrest. So all of these uncertainties could be the reason as to why we are seeing such a movement in early parts of the year. So the recent drop is not new, but it might feel unsettling for some investors. And so, do take note, even though we have seen such a drop, right? But in relative to the movement that we had from last year, this drop is still just a small portion of it from the gains that we had. Okay, with regards to interest rates hike, a lot of you are asking, when can we be expecting it? So I mean, we will never know when, we will never know for sure when this thing will actually take effect. But with the current pace of tapering, it is forecasted to end in March. So even though there's nothing concrete at the moment, there have been word on the street that the hike could happen as early as March. So yeah, we gotta just hang on for that and see how it plays out eventually. All right. Okay, so some of you are also asking if they should just try investing in emerging markets as well, or just US. So let's say while there may be opportunities in emerging markets as well, it will be good to take note that in our current global situation, this COVID-19 pandemic, developing countries might have a tougher time bouncing back from the damage left by COVID-19. So their economies maybe might not be as well equipped to handle the situation. So like just now the slides we had about vaccination rates, take that for example. We're able to see, right, the differences in vaccination rates between countries. So certain countries who are not able to provide vaccinations as efficiently might see a slower economic recovery compared to others. But still, the potential can be found in all markets. You guys are also asking the comparison between growth and value stocks. So for growth stocks, I think we're just going to talk more about the more tech side of the growth stocks. So distinction between them, I would say that long-term horizon will favor the growth tech stocks, because of the innovation that they have, and that will definitely keep them ahead in the market. But the short-term horizon, they do actually favor value stocks. And that's because their cash flow is not as heavily discounted compared to growth stocks. Growth stocks cash flow will only be realized in the later years. But with that being said, right, so growth stocks and value stocks both offer lucrative investment opportunities for investors. There's no actually a clear-cut winner between these two, but when the broader economy is in good shape, growth stocks on average do tend to be a better performer. And during trying times like now, I'm gonna say value stocks tend to hold up better. Regarding FOMC that's going on, so what can we expect from it, right? So there are definitely a lot of things to say about it, a lot of things to expect from you guys, but let's just give a quick summary of how we should approach it. So investors definitely, like you and me, we will definitely be listening closely to hear how worried the Fed is about inflation. The Fed most probably is not expected to raise interest rates or change policy in this current FOMC, the one later. However, it could be instead be setting the ground for how it will act when the bonds buying program ends. So most likely in March, most economists are expecting the Fed to raise its Fed fund target rate, maybe about 3 to 4 rate hikes, starting with the tightening somewhere around middle or later in the year. The Fed is also said to shrink their balance sheet, as mentioned just now, where they stop replacing matured securities in their holdings. This would also cause tightening as well. And also, the Fed has been more or less hawkish about their position with the rate hike and other tightening policies. However, if the Fed comes off as dovish, where they're not so aggressive about this, then by normal presumption, we would think that it is good for the stock market. But that might actually not be good, because if sentiments now feel that hikes are not going to happen, then this will actually cause long-term yields to increase. So I would say, with us all being anticipating about the meeting, I think what we can do best would definitely to be ready to just adapt with the new information. Okay, with regards to the ETF, how do you guys how can you guys start trading in bonds ETF? One guy is asking. So I just say that after creating a Poems account with us, first thing you have to pass a CAR assessment, which is provided under our online form section. But yeah, do take note that the CAR assessment is only accessible through the desktop platform. Okay, guys, I think the time is almost up for us guys over here. And I'd like to say thank you to you guys as well. Okay, and yeah, please do remember to fill up the feedback form. And we definitely see a lot of questions coming through the Q&A and also the chat. We apologize if we weren't able to answer to each and every single one of you, but don't worry, we hold webinars monthly. And also, if you do want to ask us questions or questions that weren't addressed just now, you can feel free to give our hotline a call, which is written on the screen now. And or you could also email us globalnight@phillip.com.sg. Okay. So yes, thank you from us. And with this, I think we will end off today's session of webinar. Thank you for your participation, everyone.